Hey traders, this is Blake Morrow, and guess what? It's Friday, and I have Mr. Jim Welsh from Macro Tides. As always on Fridays, Jim, love having you here, especially you navigating us through the markets. I mean, you called it below 4,000. We would turn around and rally. We hit 38.50 roughly, and just took off like a bat out of hell. Here we are squeezing today. What's next for the markets? How do you, and thank you for being here navigating us.
Always glad to be here. And I want one optimistic note here. In the next 2 weeks, we have 5 days that will be off, 3 this weekend and 2 next, and only 4 work days. So we've got the next 9 days, we've got 5 days off and only have to work 4. Anyway,
I hear what you're saying, but it sounds like you're working a fireman schedule over there. Just kidding.
Well, but then what happens the week following is we look forward and we have 2 days off and we work 10. So it does even out. I'm sorry. Okay.
I just, and by the way, I'm joking. If any of you are firemen or previous firemen, I actually worked those types of schedules when I guarded nuclear weapons way back in the 90s. So 2 on, 3 off, 3 on, 2 off. That's what it was sounding like. Anyway, hey, look. All that aside, really nasty squeeze in the markets here today. We had the FOMC meeting minutes. What are you making of the price action here? I mean, by the way, the markets are ripping on very low volume. So what are your thoughts?
Well, again, in this past Monday's weekly technical review, and I think as we touched on it last Friday, the S&P went down to 38.10, 38.11. The 382 retracement was 38.15.
Yeah,
relating to the low in March of 2020. At 21.92, the high this past January at 48.18. I was looking for a drop to 38.50, just kind of like, hey, I don't know if we're going to get all the way down there type of thing, right?
Yeah.
But what I noted on Monday was that even though last Friday, the S&P, the Dow, transports, a lot of the Qs all went to lower lows, the Russell 2000, the value line composite, New York composite, didn't. So you had intermarket divergence. The other thing I noted, in last Monday's letter was I was looking for a lower low and we would see divergences. I have an indicator that I use. It's the 21-day moving average of net advanced declines. And what happened in January and February, as the S&P made lower lows, this oscillator made a higher low, a divergence showing it wasn't as weak. And you had the 382 retracement all coming together. So also in the pattern, you can see when the S&P dropped it to 38.59, it looks like 3 waves up to that letter A, then 3 waves down to 38.10. And what that implied to me was A, an irregular B because you went to a lower low, and then a C wave rally that would take the S&P above 40.91. And since it dropped by almost 50 points below 38.59 at the low, you can kind of say, okay, a chance of 41.40. The 382 retracement of the whole decline from 48.18 to 38.10 is 41.95. And as you can see, there's a lot of resistance between 4,100 and 4,200 because that's, back in February and March and in late April, the market tried to hold that area. So there's a lot of supply that the market should run into. So my expectation was we were going to get this pop, and then you kind of have to wait and see.
Okay, well, Jim, this chart that you're showing us is old as dirt. Actually, it was from 2 hours ago, and we were well above 4,100.
Yeah.
We're getting close to that 41. We're at 41.25 at the time of me speaking, and we're pretty close to 41.40. And you see us maybe even extending out to about 4,200, which I'm going to echo your sentiments. Is that something that we've been talking about? But this is short squeeze. I mean, do you believe it? I mean, do we go to all-time highs from here, or are you looking to sell into the strength now?
Well, right now I'd be a seller into strength, but the key here, in my view, is that if we just get if we stall out around the 4,200 level, maybe better phrase this. I'm looking to see when we get a 5-wave move up. Right now we have three, 1, 2, 3. And I did put this chart together about an hour before the open of the market. And this is the S&P cash, not the futures. So I should have updated it, I guess, after the open. There's a possibility that the low is in. We hit the 382 retracement. My expectation has been that there's another period of weakness when we see earnings get lowered by Wall Street analysts. They're still expecting 10% plus earnings for this year and next. I think they're going to come down. That said, what I wrote about in the last 2 weeks is that we were coming to a point where the Fed increases the funds rate 50 basis points in June and July. That would bring it up to 175 to 2. So you're getting in the zip code of neutral. The Fed at some point in time will be able to point to, the economy is slowing. We wanted to slow demand, it's happening. But we want to see inflation come down. It's starting to happen.
I was going to say, are we starting to see rhetoric now coming from the Fed, a little bit less stern words, if you will?
Well, Bostic, he's not a voting member either this year or next year. You always have to keep that in mind throughout. We could take a pause in September. I mean, even a fire engine slows at intersections type of thing.
But when you have non-voting members, their words do count. I mean, it is a committee, even though voting or non-voting, they still have influence. If I'm Bostic and I'm talking to, Brainerd or whoever I'm talking to, I can influence that committee member. Is that correct?
Yeah. I mean, I think they're very collegial, as they like to say, when they have these meetings.
Sure.
In the framework of forward guidance, Blake, they always want to try to communicate ahead of time to prevent the market overreacting. So Bostic, either on his own or whatever, is coming out and expressing this view. Don't remember that over the last week or two, financial conditions had tightened significantly, with the S&P down 20%, bond yields and spreads were starting to widen out, the dollar strength and so forth. So to me, this is one of those things where they don't want financial conditions to tighten too much. So he might have just been out there, again, expressing his own view. It does have an impact. I'm sure others, some of the Dovers on the committee probably share those views. And that's what I was writing about. When we get close to the 2% neutral rate, in a month or two, the Fed is going to be able to start to point to progress on inflation coming down a little bit, the economy slowing. These are the things they wanted.
Yeah.
So it's possible the low is in. The first thing I want to see is 5 waves up off the low at 38.10. So far, we really only have 3 waves. So we need sometime next week and another push higher. The tricky part is that could just be part of wave C of this ABC. So it's going to be a little tricky. I'm open to the idea that the low is in. At the same time, I think the economy is going to show more signs of slowing. And, the Fed on balance is going to be talking, we need to keep moving forward. The other thing, Blake, is gasoline prices are up almost 10% from the end of April.
That feels good as a consumer.
So the CPI, gasoline is 4%. So you take 10%, that's 40 bips. So the CPI downtick from 8.5 to 8.3, but you're going to be adding 40 bips potentially into that equation. There's the chance, I think the CPI comes out on June 10th, right before they meet, where it may not tick down again. It may tick up. So again, there's going to be some real crosswinds, I think, in the next 30 days where we could potentially see another leg down. And I would be a buyer of that leg. I'd feel more comfortable doing that because sentiment has gotten pretty negative. We had 7 weeks down in a row in the S&P. So everything, those are some of the other things I cited. Sentiment got really negative. So, positioning is off sides, as you noted, short covering rally. There's no question.
And they are ugly and they are nasty, aren't they?
Well, they rip your face off. That's why they phrase, and so if you're short, there's no relief here, and the way the market trades these days, liquidity, I think, as you also know, low volume, but on balance, the liquidity in the S&P futures is quite a bit lower than it has been historically.
Well, let's talk about, the market that's gotten, beat down. You brought up TLT. Bonds have been beaten down. You can see here in your chart that you brought to us. We have, there is a potential now at this stage in the game of a possible reversal. Are we going to see the same type of move that we had in equities? Are we going to see that move higher in treasuries? What are your thoughts here about the TLT?
Well, on May 6th, when we did our Friday get together, I was looking for the TLT to drop down near 112, noted that was the low back in, I think, October 2018. And my expectation was that we were setting up for a rally that would take TLT up to 120 to the 123 level. We got to just under 120 the last handful of days. I think there's a little bit more upside. 123, as you can see, just above the red number 3, is wave 4 of lesser degree of, over to the left, but it doesn't matter. So to me, that's why I picked that number, is because that's wave 4 of lesser degree. These market rallies have a tendency to go up there. There is still the potential that we'll see another sell-off in bonds that will take us below, in terms of TLT, below the 112 reading. So I think one other point I will make about the S&P, if you look, and I didn't note it when we were looking at the chart, but it has had a propensity this year of topping in the first 4 trading days of every single month. Now, that's where the red arrows are. Now, in April, it was a little lower high in the first part, but then we rolled off pretty quickly. Back in April is when I was starting to talk about the 3850 target. So the point being is, my guess here, Blake, was that we'd see this rally up to 4150, 4200, and it could peak in around the first handful days of June. And that's where we'll see what happens next.
And I mean, we are end of month, a lot of craziness happens, a lot of rebalancing, portfolio rebalancing. So it's possible that we could rally into Tuesday, Wednesday, end of the month, and there we go.
We'll see. Okay.
Yeah, we'll see.
So TLT, I'm looking for yields to come down a little bit more. And then the euro. Back on May 6th, we were talking about the euro. And my take was, I thought we were going to see one more drop, potentially below 104. We had talked about the 2 legs being equal, was at 104.40. The low back in January of 2017, I believe, was 103.40.
Yeah, way back over here.
103.50. So when we talked about it was like, hey, I think you want to be a buyer as it gets down near 104 or below, in expectation that it could rally up towards 108. And we're almost there. So it could be a little bit more, but a lot of it's happened.
Yeah, I was going to say, so what could, in your view, what could continue to drive the euro higher from here towards 110? I mean, is there anything on the horizon that you would say, well, this could actually happen, that could continue this rally? Or should we be just selling into this rally, thinking the dollar is about ready to regain its composure and head to new, 20 some odd year highs? I mean, what are your thoughts?
Yeah. Well, again, what caused this shift is the ECB coming out and saying, yeah, well, by the way, we're going to be raising rates too.
Yeah.
And that, I think, has been, the Fed has been very aggressive in their language, and they're talking about what they're going to be doing. The ECB was kind of like in the background. So I think, obviously, that's why the euro rallied. The momentum in the dollar index, I think it will take out this high we saw in the last 2 weeks.
Really? So you believe that the euro
it may be a few months from now.
Oh, okay. All right.
So could the euro trade up towards the 108 to 108.50? Yes. I would be inclined to start to lighten up. If you bought around 104 or under, I think taking some profits at this stage of the game makes sense. And then see, whether it's half or 2/3 or whatever. I mean, that's a pretty good move in 2 weeks from under 104.
For a currency market, it's a hell of a move, right? So
I mean, it's almost stupid not to take something off the table when you can have a winning trade and you sell into the direction you're positioned into that strength. It's like, thank you, because it is what it is. So
yeah, and price action will be everything from here. Whether the euro can, if the euro can absorb that selling and hang out above 107, probably will tell a lot in the coming days and week ahead. So by the time we meet again, Jim, we're gonna be past the first of the month. And by the way, I need to mention this. If you guys like what Jim has been doing here, give him a thumbs up. Get down in the comments, comment down below, comment on Jim's, analysis. If you have anything you want to add, make sure you do that here, on YouTube, and, subscribe to the channel so you don't miss any of his content that he brings here exclusively to us every single week. But I want to say, Jim, going into next week, I know it's month end. Anything else we should be, on our radar that we really need to be aware of going into next week?
No, I think we pretty much, again, we'll get the employment report. So I don't think there's, at the end of the month and that there isn't a whole lot of, we got the ISM number coming out. And the point again. And we will see the ISM
manufacturing, not the services, I don't think.
Probably, I'm not sure. That's usually about day 4 of each month. So it might be Monday instead of Friday.
Right.
The one thing real quick here, Target, Walmart came out and the stocks got crushed, right?
Yeah.
And I think people inferred, that, oh my God, the economy's weakening. No, both companies had revenue growth of over 3%. What happened is that they positioned, their inventory was overladen with major appliances, furniture, furnishings, TV. And the consumer is shifting away from goods to services. So Walmart's inventory is up 32%, Target 42%. Here's the point. They're going to move that inventory by lowering prices. And that is going to feed through to the CPI over a period of months. The other thing they're going to do is they're going to cut back on orders. So we are going to see the ISM number drop in coming months. And the new order in number, Blake, I'm writing the June macro tides now. I think it will drop below 50 over the next handful of months. So these are some of the dynamics, obviously, the Fed is going to be paying attention to. They wanted to see demand decline. We're seeing some evidence of it. But again, the consumer is still in healthy shape, which is why I don't believe a recession is going to happen in 2022. And I still think there's the potential for the S&P rallying to new all-time highs next year.
Great. And then I need to mention this. If for some crazy reason you missed Jim's interview last week and he talked about the potential risks of a depression in 2025, make sure you get on our YouTube channel. Go back and listen to that interview last week. It was awesome. Jim, I want to say have a great weekend. It's always great chatting with you and catching up over the week. You have such a great handle on the markets. How do people follow what you do?
Macrotides.com. And if you send me an email, because you're a faithful listener to Trader Summit, Jim Welsh Macro, and I'll send you the last weekly technical review, which kind of covered in detail some of the things we've discussed this morning.
And that's Jim Welsh Macro at gmail.com, correct?
Yep. You got it, buddy.
Forgot the Gmail, so we all know that.
Oh, yeah, well, it's Friday, man. It's been a long
I know, it's
week.
been a long week. Hey, Jim, thank you so much. Have a great rest of your day. Have a great Memorial Day weekend, 3-day weekend for you and your family. And we'll catch you next Friday.
You got it, buddy. Thanks so much, Blake.
Hey, traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.